While some online bullion dealers continue to charge $4 over spot for U.S. Mint Silver Eagles, SD Bullion is selling 2016 Silver Eagles for just $2.29 over spot for any quantity. Again, that's just $2.29 over spot for any quantity. If you haven't joined over 25,000 new customers by making the switch to SD Bullion, what are you waiting for? You could save hundreds or even thousands of dollars on your next order. SD Bullion, the lowest prices, period.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, Eric, both gold and silver were hit hard this morning, right at 8:30 on the dot when the BLS released the July jobs report. Ridiculously unbelievable numbers of like over 250,000 jobs they claimed were added in July, making it over 500,000 supposedly in the last 60 days after almost an even number in May. So the farce continues. Gold was smashed it was trading just around 1365 early in the day here on Friday. And traded all the way down almost to 1335. It's been trading under 1340 here throughout the early afternoon here on Friday. We're recording about 2:15 p.m. New York time, and gold's trading right about 1338 right now. I wouldn't be surprised to see that number move up towards 1345 or 1350 before the session closes and before Globex trading closes for the week, but we'll see. And silver also hit pretty hard from about 2040 all the way down to about 1970 in silver, so about a 70-cent move just a couple of hours in silver. So what's your take, Eric, on we'll start with the BLS and then the gold and silver's trading here?
Yes, these numbers were pretty surprising. I mean, the jobs payroll came in at 255,000, and the expectations were only 180,000. And there's some honkingly large seasonal adjustments in this report, and also in previous monthly reports. They've also been upwardly revised. It's a really fishy report. The timing of it reminds me of the election reports and unemployment reports timed in 2012 that were ultimately outed as being outright manipulation. It just smacks of that kind of an effort going on. Given the size of this beat, I mean, they came in way above the highest estimate from all of Wall Street analysts, and there are or at least I think it was 45,000, if memory serves, jobs that were added within education in July, 2/3 of which were government jobs that were being hires in July when schools are out. I mean, it doesn't make any sense. And the BLS has basically come under a lot of criticism in the last couple of years for their seasonal adjustments in particular, and it's very clear that that's what's going on here as far as these numbers are concerned. The Federal Reserve and policymakers in general have been trying to convince the world that the U.S. economy is going to see a strong third quarter and fourth quarter. It's largely hopium in the face of the data that we get when we look at pretty much almost universally private sector source data and industry data that shows trade flows falling off a cliff and unemployment growth stagnating outside of metrics that the BLS serves to us and so forth.
And if you look at it just yesterday, Zero Hedge reported that year-over-year tax withholdings were down quite markedly in July. So, I mean, that tells us that we should have expected bad jobs numbers. And I want to ask you, Eric, particularly with how horrific May's number was and then the two numbers since that have greatly exceeded expectations, what do you think the potential is that May's numbers were fixed to the downside in order to prepare for 5 or 6 months in a row of completely goosing the numbers for Hillary? I mean, the numbers, they seem like they're fabricated whatever they feel like. It doesn't seem too far-fetched to me to think that they could plan and schedule ahead that we're just going to completely fabricate the numbers for 5 or 6 months going into the election for Hillary.
That was actually one of the hypotheses that immediately popped into my mind when I looked at the data and decided on whether or not, the seasonal adjustments are being tweaked in one month or another month, and it does look like that may be part of the political motivations that are behind what's going on here. It's impossible to tell. There certainly is a case strongly to be made that what happens with these academics and their models that they play with is that they overshoot. They overshoot in both directions. They try to constantly rejigger and readjust, and ultimately what they produce is nonsense. And it's great that the Treasury is still reporting the tax numbers. I mean, Charles Bitterman at Trim Tabs has been talking for 20 some odd years about how the U.S. BLS labor reports are kind of farcical, because all the government needs to do is just look at tax rolls and see a direct, real-time data stream that they could build far better models from and actually give the market and investors real information, as opposed to this fantasy star chamber computer algorithm mediated version of the world that's really just farcical. And I'll turn to the Atlanta Fed numbers as well too to make that case. There was a time, I guess about first quarter of 2015, when this relatively new economic series produced by the Atlanta Fed, called the GDP Now series, caught a lot of attention, and people believed that, maybe these guys in the Atlanta Fed district have come up with a better model that more accurately reflects the world, because back in 2015, their model was initially entering the year with a forecast of 3.8% GDP growth for the year, and then by March it had crashed almost to zero, which was matching with the downward deceleration in various sectors that we could point to, and it just jived. So a lot of people, for the first half of last year, were looking at the Atlanta Fed saying, oh gee, maybe these guys actually have a better sense of what's going on in the world and their models make more sense. But if you fast forward to today and you look at where the Atlanta Fed guys have been jiggering their models, we went from an estimation of a little bit less than 2% growth in the end of July to a blast higher, now estimating a 3.8% appreciation in GDP. I mean, this is just 2 weeks. And they're justifying it on post-Brexit calm and quiescence in the marketplace, in the financial markets, not translating into slower economic growth. More likely than not, I'm just taking a guess as to what some of the parameters that are going into that model. But the take-home point is that in an 18-month span, this beast of a model had swung between 3.8 to almost zero, and had done a full 6 round-trip returns with at least a spread of over 2% growth in those round-trip returns. Up, down, up, down, up, down. I mean, in 2015, the thing looks like an EKG diagram chart of somebody having arrhythmia problems with their heart. And this is what passes for economic analysis in the United States. I mean, it's really quite farcical, and basically our policymakers are just kind of working with assumptions on where they would like sentiment and perspective to rest, and then re-engineering their data to try to shape expectations to move the market in a direction that builds their economic reality they're targeting. It's not a measurement goal. They're trying to manipulate everything in our economy. And it's getting to the stage where the level of management of our economy is producing a level of malinvestments that ultimately will end this long charade and Keynesian financial management of everything. All things said, gold and silver today, as you were alluding to, and speaking about the possibility of a bounce back in the markets as we go towards the close, may or may not happen, but the reality is that all things considered, this kind of a downdraft is small relative to what would have happened with this kind of a beat in expectations if it were to have been, say, it's this time last year. The overall interest in precious metals remains, and people are buying this dip. You're seeing purchases at SD Bullion, and this hasn't changed the overall sentiment and understanding of what negative interest rates are going to do to precious metals over time. It hasn't changed the overall understanding of what's going on within the banking sector in Europe in particular. This is noise. It's going to be possibly pretty painful noise, because we're going to, if past is prologue, we can expect probably a long chain of jawboning from Federal Reserve officials talking up as early as next week about, we probably should raise interest rates in December and so forth. And so it's possible that we will see a little bit more pressure coming into precious metals as a result. And, the timing of this is not coincidental either, because at the start of this week, it was very clear that silver was going to take out 2050 and stay above it, because after, 16 times, I forget how many times we've seen outside reversals this year, some of them quite large, the continued interest among investors to purchase silver, even though we have this kind of confusing situation going on with the U.S. Mint's allocation that we've talked about in a number of shows, continues. The tape tells the tale. The action in the mining shares tell the tale, and that kind of a bullish move just doesn't evaporate on a surprise in the unemployment numbers that the Fed or the Bureau of Labor Statistics is dishing out today. So, it's depressing seeing how pretty much everything in our markets these days are now managed to the point of absurdity. They manage everything. But this bull market in precious metals is going to continue on. If anything, maybe we'll see the Fed crazy enough to raise interest rates in December, and that could conceivably upset financial markets. Who knows? Initially, the euphoria that we see today, for example, of stocks going up, and one of the Tylers in one of their articles were joking about how stocks go up no matter what the unemployment report is. But the euphoria now is not so much fear of rising interest rates, but the Fed's success in delivering the message that interest rates rising will be an indication that the economy will be performing better, and that corporate profits in turn will rise, and that will be good for the stock market. And that's been one of the major concerns that a lot of investors have had, because since about 2014, corporate profits have, generally speaking, been on a decline, in keeping with what's been going on with the decline in the economy. So here we are, another new high on the S&P 500, courtesy of managed economic statistics and market manipulation.
Yeah, great for the average Joe's 401k for now. Keep them drinking the Kool-Aid for another week or two.
Yeah.
Yeah, the physical situation certainly is interesting. We continued to see very strong demand. SD Bullion had our strongest sales month ever in July. But yeah, it's interesting. The U.S. Mint here on Friday is reporting that they've only sold 75,000 Silver Eagles for this first week of August. And to put that number in perspective, we've sold right around 10,000 2016 Silver Eagles just at SD Bullion this week, and probably 20,000 backdated Silver Eagles. So you really can't take that number at face value. As we've discussed in recent shows, I think a large part of it is the APs have built sufficient inventories, and they're basically selling into their surplus to work down their inventories a little bit. I think they all recognize that they're not the only ones that have coins, so they're made a decision rather than to continue stockpiling in hopes of a shortage, to try to work off some of that excess inventory so they don't have as much carry cost. Because just the financing, you're talking somewhere around 4 or 5 cents an ounce per month in interest. So these big wholesalers and APs and dealers, they don't want to carry any more inventory than they have to if they don't believe there's going to be a shortage anytime soon. So I think you'll gradually start to work off that inventory. It's hard to say exactly how long they'll be working through inventory before they ramp out their buying. And again, it'll really be affected by what the market does here. If silver hangs around between 1950 and 2150 for the next month or two, versus taking out 22 to the upside and really picking up steam towards 26, that'll bring a lot of investors back into the market, because they'll clearly see that silver has bottomed, is breaking out, and is likely headed back towards $30 and above in the long term. So basically, a long story short, it continues to be a great time for investors premium-wise to acquire gold and silver, especially on days like today where you get a 70-cent dip in silver and you don't see a skyrocket in premiums. I mean, last year, anytime like today when the market was short coins and then spot prices dipped $1, the premiums almost, in some cases, actually went up more than the price of silver dropped. So, I remember about this time last year, days where silver was down $1, Silver Eagle premium was up $1.50, so it was a wash, or if not higher than the you're paying for the coin than it was 24 hours earlier with higher silver prices. So,
yeah.
So that's the real benefit of the market situation right now for physical investors, is that premiums aren't instantly spiking anytime you get a little bit of a downside move in spot prices in silver.
I want to throw out one other thing that's occurring to me from the global macro perspective. This whole effort to put back on the table raising interest rates in the near term as early as probably December, if my assumption about what jawboning is going to bring us next week is proven correct. China is in a real difficult position right now, and they want to devalue their currency a little bit more faster than what they've done in fits and starts over the last year. And if we go through a period where the dollar is once again catching a lot of flight capital and a lot of capital seeking to get in front of the Fed's raising of interest rates, that's going to cause quite a great deal of friction between global markets as it pertains to what happens when the yuan declines by, say, I don't know, maybe 2-3% or so in the next remainder of this year. I mean, that's a possibility, and that kind of turmoil will ultimately do to our stock market what it did back in August. If they do something very quickly, if they're trying to, rock the boat or send signals to the Fed like they did back earlier this year when the Fed did their when the Fed raised their interest rates in December 16 of 2015. I believe it was the very next day or the very next evening the Chinese had devalued their currency, and it was basically a shot across the bow to the policymakers in the United States, almost like blackmail, basically saying, hey, if you do this and make it more difficult for our economy to function because a rising dollar would make it more difficult for us to deal with our effort to devalue the currency and then have a currency war and beggar thy neighbor dynamics going on amongst Asian trading partners in the region. China basically sent a strong message to the Fed to back off, and the Fed did back off. So we have all these kind of contradictory confluence of forces, and it's pretty messy trying to figure out where the markets will go based on how policymakers are going to try to interpret what's going to happen, say, in December. But who knows? I mean, this scenario and what's happened this week, and with the way the job numbers have been politicized, it kind of looks like they're trying to paint a picture of an improving U.S. economy, strongly supporting the election season, putting a favorable tint towards Hillary's victory and presumably maintenance of Janet Yellen as Fed chair. So Yellen must be happy with BLS supporting this kind of a narrative, if she's even thinking along these terms or along these lines. I mean, certainly Trump has already indicated that he would probably fire Yellen if he were to be president. It's going to be an interesting year. This election season as well, too, is going to heat up and make what we've seen so far look tame in comparison. I have a feeling that Trump and Hillary are going to put in for the record books a kind of level of attacks against each other that was just going to blow people's minds. And that isn't going to be good for confidence either.
I'm not personally a Trump fan, but I think I'm looking forward to watching Trump-Hillary debates. I mean, you could see those TV Nielsen ratings numbers as good as a Super Bowl, I would think.
Yeah.
I'm just imagining a Trump-Hillary debate, and if Trump shoots his mouth off like normal, we might not have to worry about election. Hillary might just have a stroke right there on live TV.
Or maybe they'll just get into a fist fight. Presidential debate fist fight, film at 11.
I mean, if Trump just comes out and says some of the things that he's indicated he will already. I mean, he's already brought out Vince Foster. All kinds of stuff about Hillary already. If he starts bringing out things out of the closet on Hillary during a nationally televised debate, she might just pass out.
Yeah, who knows? Generally speaking, it's dangerous to do those kind of things that are, painted as negative election.
That's why it would never happen. But Trump, you don't.
Yeah, he's definitely capable of it, and so is she. If Hillary's crossed, she gets this kind of like defensiveness that could easily make her irrational and throw out some real good bombs in a television debate too. So. It's going to be fun watching these debates. I usually hate watching these things live, but I might actually turn on the television and check it out. Just pop some popcorn and see how it goes.
Must-see TV.
Yeah.
All right, so on that note, I'll turn our attention back to the markets here. Again, as Eric said, it'll be interesting to see next week if the Fed goons are charted out on TV in the early part of the week and threaten rate hikes in September or even December, and try to talk through or further the talk of today's action here on the BLS and see if they can walk gold and silver down a little more. But again, gold still trading above 1,300. I mean, it's still trading above 1,330. So the long-term outlook, gold really hasn't even broken below its recent uptrend. So that might be the number to watch over the next week. It certainly wouldn't be surprised to see them try to take or push gold down through that to trip some of the algos into sell mode rather than buying the dip. So
yeah, and as a parting shot too, since we're recording before the close and we don't have enough data, one thing that our listeners need to look at over the weekend is how much the open interest in silver declined, because that'll be pretty telling. I mean, the open interest hit all-time highs earlier this week as J.P. Morgan and friends were issuing more short contracts to absorb all of the rising long interest in the COMEX. And with this decline in silver, hopefully we're seeing a pretty decent amount of short covering, and that would clear the deck and help the healing process and our return back into the 20-plus handle quicker. So we'll see how that shapes out and what we see in the data, and we'll talk about that on the next show. But other folks in our sector will certainly be talking about it over the weekend, and you know who the usual suspects are. Turd Ferguson does great work on that, so any of our listeners can check out his work or Bill Murphy's work, Dave Kranzler, etc.
And again, one final thought on the markets with silver. After how much silver moved up, I mean, it moved up $4 in a month here. So a little bit further time to consolidate long term is going to be healthy for the market. So
yeah.
All right, so it's a brutal day for gold and silver here today, but hopefully it'll be short-lived as all of the algos and the funds jumping on the BLS bandwagon. Hopefully a little bit of rationality to return to the market next week. It'll be nice to see gold get back above $13.50 and silver obviously get back above $20 early next week, or else, as Eric alluded to, you might see the selling continue.
It's probably not likely silver is going to get over 20. In a snapback fashion, unfortunately. This is probably going to take at least a week for us to really heal and move well.
All right, well, we'll be rooting for it.
Yeah.
All right, so we'll call it a wrap here for the Doc and Eric Dubin. Thanks for tuning into this week's SD Weekly Metals and Markets.